Good afternoon, ladies and gentlemen, and welcome to this, I think it's third in the series of the webinars or the weekly reviews that we do in relation to the trading here at Bull and Bear. So there's been a few questions already come in for today's session. So if you have any others, please send them in now and they'll get forwarded on to me, and I'll do my best to answer them during the course of today's session. So the first thing that we have on the screen here today is the trades for the week. So it's been another profitable week, as you can see, 1291 pips returned. The pleasing thing for me, I suppose, if we look at the totals for each day, is there's been a positive return each day. It's a holiday shortened week today. Lack of liquidity and volume in the markets that we trade, so just took 4 trades fairly early and still managed to return a triple digit return for the day. So I can't really complain about that, and I'm certainly not. But fairly consistent returns throughout the week. Monday obviously being the better day or the best day, and then returns the returns for the rest of the week hovering around 200 pips on a daily basis. A few things of note, and I suppose the thing that I always focus on when I'm looking at these screens are the losses. So those that show up in the red colour, or pinky red colour, should we say. So one on Tuesday, 171 pips in the gold. Gold, as you'll know from those of you on the channel, I expected it to hit strong resistance around 1780. Didn't really materialise. We went through it far too quickly and up to 1785 where I stopped myself out. So a fairly big hit there on Tuesday, but still a profit returned on the day of 175 pips. So I want to talk a little bit about stops before I get through to your questions as well. And I know some are related to that. Then on Wednesday, the opening order trade that we've spoken about, or the opening bell trade that we've spoken about in relation to New York, didn't go according to plan. We did fall away afterwards and trade back below these levels, but I stopped myself out as the market started to rally ahead of the opening bell in New York. The problem from my own perspective is I was in the trade too early, and then we had a fairly steep rally up to 230, and then it was difficult for me to stay in the trade as long as I wanted to. So there were small trades, less than half what I would normally trade, but equally so the momentum that was in the market at that particular point did spook me and lead me to get out of those trades, but still a profitable return on the day. On Thursday, obviously, the trade of note there is the 250 pip loss, which was around the non-farm payroll announcement. Again, very strong numbers coming out of non-farm payroll, unemployment a lot lower than the markets and market participants were expecting. And we saw a rally up towards about 26,080, 26,090 on the upper limit. This is in the futures. And then the market fell way below the levels that I'd traded at. But again, the capacity to run that trade, the fear that we were in a bit of a short squeeze at that time forced me out of the market, and I took a 250 pip hit on that particular trade, yet still returned a nice return of 264 points, however you want to describe it, on the day. So they're the things that I focus on, things that go well. You kind of take them in your stride, but the ones that I really want to look at and spend a little bit more time understanding are the ones where losses have ensued, and then think maybe about what I should have done differently in that regard. It's very rare for me to trade around the number. I was speaking to somebody earlier today about how I usually trade the numbers, and yesterday wasn't a great example. You tend to see a fairly big movement, and sometimes you can have an elastic band type movement where you have movement in one direction, which can be quite marked, and then you have a movement back in the opposite direction. That happened yesterday again with non-farm payroll, with the rally up to 26,000 and change, and then a fall away back down to around the 25,600 level. So more often than not, you're better to wait for the movement to happen before you decide what your trading position is from that point. Are you expecting a continuation, or are you expecting a reversal? More often than not, I would be looking for the reversal. Unfortunately, I didn't do that yesterday, and just before and whilst that trade had been against me for an hour or so prior to non-farm payroll being announced, just in the movement that existed immediately before the number coming out, there were opportunities for me to break even or take a small loss on that particular trade, and they didn't do that. One of the subjects that's come up quite frequently, or a lot recently, is in relation to stops and how people place those. And as you know, 9 times out of 10, or maybe 9.5 times out of 10, when I'm initiating a trade, there's no immediate desire to put a stop into that trade. Firstly, that's because I expect every trade to win, not that it does. But then I look to assess market conditions, and if you are too rigid around stops, I think it can work against you. And one of the occasions where that becomes quite true, and I know that a lot of you will have gone through education programs, and you would have had things like the risk return ratio and where you place your stops drummed home heavy and hard. And there is a definite risk management situation which needs to be adhered to in that regard, and I never try to shy away from that. But I also try to look at everything in the context of what's occurring on that particular day. So, giving yesterday as an example, why did I allow that trade to run as long as it did? At that particular point, I think I was up about 330 pips. I was quite sure that the market was going to reverse. I couldn't allow myself too much longer to stay in that belief. So I was allowing the trade to run and breathe and have the opportunity to reverse as long as I possibly could. So I stopped myself out at 26,040. I think in some of the comments that I put through to you earlier in the day, there was a stop at 26, or there was a fairly wide stop at 26,100. If I'd stayed with that and allowed the trade to play out, I would have been able to take a profit when we fell back towards 25,600. Unfortunately, I didn't do that. I stopped out a little bit early because I had a couple of other positions on. But I will always look at the stop in the context of the profit for that day. So one thing that hopefully you will notice, if a day isn't going particularly well, and I've had a couple of losing trades early on in the day, immediately you tighten up your stop and you don't allow trades to run quite as long. The one thing I think that a lot of people find very difficult, and I totally disagree with, are when you, and the way that a lot of people teach you how to use stops, is trying to move your stop to break even as quickly as you can. Obviously that reduces your risk and is an effective risk management tool. But I think what happens when you move unless you're on a very significant trend or a very significant breakout, which don't occur that often, you're going to stop yourself out at break even more often than not. So if your profit potential is break even, why take the trade? I'm a far firmer believer that when you see profit in a trade and you're even considering moving your stop to break even, take the profit. Take the profit, put it in the bank. You will get the opportunity to get back in the trade at some point. And if you don't, it doesn't matter. You know, there's a lot of wishful thinking about how you could have continued on in that particular trade for a significant return. But as I said, 8 times out of 10, you're getting stopped out on these trades at break even with no return at all. And with a lot of these breakout strategies and other trading strategies that you've seen. I was speaking to one of you about it today. Even to get to that opportunity where you've had the 8 break-even trades, you've also got a number of losing trades with fairly tight stops on them, and it all accumulates. So be very, very careful around that. I do, of course, recommend you all trade with stops. For me, it's a very personal thing. I am prepared to allow a trade to breathe and run a little bit more than most people. But I do think that you should have a stop that you put in, and then assess market conditions as the trade starts to develop. Some people use a trailing stop. It's not something I've ever used. The psychology for me of a winning trade is to take the profit and then get back into the trade if possible after that. So I'm just going to go through some of these questions now, and then if we have enough time, then we should look at that. So there's a question here from Mike Graham saying that I mentioned a while back about maybe getting another trader on board. Obviously I have a lot of friends who I've worked with in the markets over the years, and the majority of them remain friends. There are 1 or 2 people that would be very interested in doing something like that. There will be an announcement in a few weeks in relation to a genuine or a YouTube channel which will be open to a broader or open to the wider public. So on that channel there will be me and one other, somebody with 30 plus experience of trading on trading floors, of trading on exchanges, does a lot of really good technical analysis, is a very experienced trader. So he will be joining me on the YouTube channel or the YouTube program, whatever you want to call it, and we'll be looking at trades that some of the retail traders have taken, and trying to identify what they did that was particularly good or correct about their particular position at that time. And we'll also do some analysis around specific markets, both forward-looking in terms of the week ahead and the week in review. So an announcement should be coming up on that in the next couple of weeks, and we should be going live with that fairly soon after. So Tim is asking, are we planning any training programs or courses to help people understand matters further? Again, the YouTube channel, I think, will do that. We'll look at some of this person's very clever analysis of the markets and really get into the detail of it, and we can look at the recommendations from the previous week and how successful they were, and also forward looking in terms of the market. So the YouTube channel will facilitate that in the immediate future for whilst we maintain or we continue in this lockdown type phase where we can't do live face-to-face events. As soon as we can, and as soon as we can move around both UK, Ireland and further afield, we'll start to do some live events where the two of us will travel out and put on probably a morning event where we talk about our different approaches to the markets, and everybody has a different approach to the market. He is very technical, very chart focused, whereas a lot of what I do is more based around sentiment and the prevailing bias or feel for that particular day, and you'll see quite markedly the difference between the approach to trading. We'll also be able to take any questions that you may have at that time and give you some further explanations or insight into what we do. So Gary is asking what's the non-farm payroll from the other, or the NFP from the other day. It stands for non-farm payroll, Gary, and it just relates to the change in the employment numbers in the US month to month over that period. So it's just a barometer, if you like, of how the employment is going in the United States at that time, which obviously leads on to economic activity, and in turn will lead on to the amount of people that then can purchase goods and services, etc., etc. So it's just a good indication, or an early indication, of how the economy is faring at any particular time. And it's been a number that's been followed for decades, and always occupies a lot of attention around it's always on the first Friday of the month, bar this week when it was on the first Thursday of the month. So Chris is asking me about managing risk. Again, what's my criteria for cutting it, and how far do I let them run before deciding to cut? It's not an answer that I can give you in a very straightforward manner. It really is relative to the particular trading day. So, giving you the example of yesterday, where I had a fairly decent profit in the run-in to the non-farm payroll number, I allowed that to run a little bit further than I normally would. As soon as I'm approaching 200 pips or 200 points of a loss in the Dow, I'm considering cutting. In the DAX, it's about 100, probably somewhere between 75 and 100. If I was trading currencies, it would be about 60 points. And with gold, probably something similar to the DAX, around 100 points. So that's as I'm approaching those levels, and I don't wait for that level to hit, as I'm approaching those levels, that's the level that I'm starting to consider, this isn't working and I need to get out of this. Yesterday being a bit of a slight difference with yesterday, in that I allowed it to run on. As I said, had I stuck to the stop that I originally put in, I would have stayed in the trade, and I could have eventually turned that for a profit as well. In a similar question, Asim is asking, when holding a position overnight, do I place a stop on that position? In an ideal world, I would like to tell you yes. The problem with overnight trades is you don't obviously have a live market in the product, or you don't in the Dow, the DAX, or some of the other indices that we follow. So there's no live market, and I am reluctant to place too tight a stop in those markets. Gold is another one where there are lots of idiosyncrasies with it. I think gold always overreacts during the Asian time zone. Sometimes you can see a market rally distinctly out of line with where it's going to open the following day. So the golden rule, or the main rule, would be not to run anything overnight. But in the isolated cases that I do, I'd like to keep the stops reasonably wide. And the reason is that there can be a lot of activity, a lack of liquidity within those hours, that gives a misleading indication of where the market really is. So last question here. There's two further points. And there's no name on this one. Would it not be possible to give us an indication that you may be able to take on a trade? I don't place too many limit trades, to be honest with you. In terms of the prices that get filled, there should be swings and roundabouts. I know, in speaking to a number of you, that there are swings and roundabouts. Sometimes you get a better feel than I do. I'm not necessarily looking for a level. What I'm looking for is a change in momentum. or a change of direction that comes about from a candlestick. So because them market transactions, it's impossible to tell you that in 15 points the market is going to turn direction. I just can't do it, unfortunately. I'm looking at stuff on a live basis, and when I transact or when I trade, it's a market order, so I'm hitting a bid or I'm lifting an offer, and it's not possible to say in 15 pips or 15 points I'm going to do this. Sometimes around support and resistance I can give you an idea, or I may place a limit order, but it's just not the way that I trade. So it's more about looking at the ticker tape, looking at the candlesticks, and just seeing when that movement is starting to peter out, and whether or not I can take a trade around that particular movement. So my 20 minutes are up. I've answered a good number of the questions. There are a few more. We'll cover those off again next week. Thank you very much for joining me, and hopefully we get another good trading week next week.